Welcome to Breaking Bread Presents Gaps 1.5. Now, this originally was going to be a two-part series, but I completely understand how a lot of information can be overwhelming. So we're going to baby step this one. So in this video, I'm going to dive just a little more deeper into gaps. Now, I know you're asking, who knew we can go any deeper? And I get that. It makes sense. Gaps seem simple, and they are if you know what you're looking for. And that's what we're going to go over in today's session. So a quick disclaimer before we begin, this video is for training purposes only. I am not a financial advisor. I am just sharing with you the tools and ideas that I use when day and swing trading. So you assume all risks when using these tools and ideas that I share with you when you enter and exit your trades. All right, so gaps. So what are we going to talk about in this video? We're going to do a quick refresher. We're going to talk about looking to the left, biases, support and resistance, market sentiment, same-day gap fills, and then where to find these gaps. Okay, so a quick refresher about some of the things that we spoke about in part one of this series. We talked about the reasoning for the price to gap up or gap down. And some of the examples I gave were one, news. That's your unexpected events like a war or COVID. Then you have your analyst recommendations. That's when a stock is upgraded or downgraded. Then you have your economic report, that'd be your CPI, your unemployment numbers. Then, of course, earnings, which is reported quarterly and sometimes annually, depending on the ticker, but that also can cause price to gap up or gap down. Then we spoke about asking yourself the following questions. Who was in control before the gap was created? The buyers or the sellers? So we look for gap plays to where if price gaps up, you want to see buyers already in control. If price gaps down, you want to see sellers were already in control. And then you want to know, does the information that was released have direct impact on the stock? So if you were playing CVX, let's say, that was originally in a downtrend and it gaps up due to unemployment numbers, which is not direct news from that stock, from that company, then sellers that were there before the news came out may still be in control and can fill that gap that it created after hours. But then let's say if you were in CVX and it gaps down due to earnings, that is direct news from that company. So you would look for continuation to the downside. And then we ask, did price gap to a previous level of support or resistance? This is where you want to look to the left. Did price gap up or down to a previous level of support? And then last but not least is use your fib tools to find the 50% in the 61.8 level of the gap. Now, price is attracted to these levels, and I recommended that you take profits at one of these levels. If you're not familiar with the fib tools and what the 50% is and the 61.8 level is, go check out my fib video, and I'll break that down as to what that is and how to use them. All right, so what's an example of a gap up? This is what you see here. So price closed the previous day down here. Next session opens, price opens above. So it created this gap in price here that you see represented by this space. So a gap up is when the previous day close is below the opening price. It has to be a significant amount though for it to show this gap like this, but it's represented by this space, and this is a gap up because price closed here, opened above. Now it's the reverse for a gap down. You can see here price closed above, and then the next opening session price opened below the close price. So when the opening price opens significantly below the close price, that gives you this gap in price, which is the space that you see here. So this is a gap down. Price opened up here and went down in price and opened down here. So that's a gap down. Then we talked about the type of gaps. So you have your same day gap fills, and this gap is created after hours and is filled the next opening bell takes place. So a gap is created after hours and is filled the same day when the next session takes place. Then you have your gap and goes. Your gap and goes are your continuation plays. This is a gap created after hours when the opening price is higher than the previous day close And when the next opening bell takes place, momentum of price continues in the uptrend. So price gaps up and it continues once the market opens to the upside. Then we have your gap and fade. This is the reverse. This is to your downside. So again, this is when a gap is created after hours. And this is when the opening price is lower than the previous session's closing price. And when the next opening bell takes place, momentum of price continues in the downside trend. So price gaps down and it continues going down. And minding the gap, these are gaps that were created previously and price has returned to that area to possibly fill it, reject it, or bounce off of it. So you want to be mindful of that. All right, so let's go. All right, so looking to the left, you always look to the left and see the story that price is telling you. Now, this should be a rule regardless of what you're trading. You want to always look to the left at the story price is telling you. You can't skip to the end. Don't try to skip a chapter. Looking to the left can sometimes tell you the answer that may come. See the story that after hours is telling you. See the story that the higher time frames are telling you when looking to the left. You're looking for these areas where price rejected or bounced before. And then you want to see who's in control by looking to the left also. So if you look and see if price has gapped up or gapped down to a previous level of support or resistance, this can possibly be a setup for an exhaustion play, and price may head in the opposite direction. So you want to always make sure you're looking to the left and see what price is doing. Price has memory, right? So looking to the left will tell you what it did at particular key levels in the market before, but you have to look to the left to find this information out. All right, so biases, you have your emotional bias and then technical analysis biases, and they are not created equal. So you may hear traders say to not have a bias, but there is a difference between emotional bias and technical analysis biases. Emotional biases, of course, is what you feel, but is not backed by any type of data to support it. I'm sure we've all either said it or heard someone say, I know SPY is coming down, period. What supports that statement? But a technical analysis bias is when you say, I know SPY may be coming down because it has rejected this level once before, and it's rejecting my VWAP, my EMA, my broadening formations, my support and resistance, and my supply and demand zone. That is a strong level of support for your bias. So I always say if price is not aligned with your feelings, then trust price. The market doesn't care about what you feel or think. You want to play off of what your analysis, your technical analysis is saying. So the more that you have in your favor, that sets you up for a high probability to take that play, whichever is favoring the direction of your bias, your technical analysis biases at least. All right, so support and resistance. The tops and bottoms of these gaps can act as support and resistance levels for price. So we know price is attracted to a lot of levels in the market, and gaps are one of those things. You will see price head to a gap and bounce or reject depending on the direction of price. So when you see price approaching a gap, treat it as such until buyers or sellers step in, breaking those levels. Of course, I got examples. Let's check it out. All right, so here you see shop on a day chart, and then you see shop on the 1 hour chart. See the previous gap, downgrade, downgrade, previous gap. I think this gap came from like 2021 or 2022. This is an old gap too. And the orange lines are my fib levels. So 50%, 61.8. So as you can see here on the day chart, price treated these gap levels as support and resistance level. So price came down, went to the top of this gap and bounced off of it, support. Price went up, didn't quite reach the bottom of this gap, but it rejected resistance. Came down, support. Came up, resistance. Came down, support. Came up, resisted. Came down, support, and then we finally broke through. It got as closest to my 50% fib level before it retraced to pull out. That's why I say take profits, some profits here when playing gap fills. And what I say in the first video, when price retraces, I call that going to get gas to continue back to fill this gap. Now, how far it retraces We don't know that, but it has to retrace to get some fuel and come back and fill this gap. Now, this day right here, shop got downgraded. So it gapped down. So that assisted with getting over this previous level of support or getting under this level of support. So when price gapped down, it continued, it broke through my fib levels. It finally filled this whole gap down here, bottom purple line. When price got under that, as a gap filled, and we continue down. So this is an example of these gaps acting as support and resistance. Support, we resisted. We supported, we resisted. We supported price, we rejected price. Supported, then we finally broke through here. All right, so another example would be here on CVX. We have a 1 minute chart, 1 hour chart. Gold lines are my fib levels, gap up here, that gap over here. This gap purple here is a gap from 2022. So the shaded area is the after hour tradings. So if you see price during after hours never really got into the gap fully. It actually rejected a level here. If you can see this long wick on this white candle here. So it never really fully got in the gap, and then it started to pull back. This purple line is a Barchart formation. If you're not familiar with the strat, that's what we use on our charts for support and resistance levels. But price got back below my Barchart formation. It got to the bottom of this this gap and rejected off of it. That was during pre-market. When the market opened, it did it again. It touched the bottom of the gap, rejected. Touched the bottom of the gap, it rejected. So when I see that, this is playing in my favor to take this to the downside. I have price rejecting previous level. It's not reaching my Barchart formation, and it did the same thing pre-market. So that is aligning with my favor to have bias to the downside. This is based off technical analysis to why I have this bias to the downside. As you can see, price came down, it got into the gap, and it retraced. We went and got some gas. We went back to the top of this gap. So now the top of this gap is now resistance level, right? Next candle opens, it resisted the top of that level again, and then pulled back. Next candle, pushed all the way down to the 50% level of the fib level. And then it finally broke through, and then we began to retrace. We had to go get some fuel, and then we gave it another go. And as you can see on the 1 hour here, it filled this whole gap. This purple line here is where the gap is filled at, and it did that. Price got under that, so this is considered a gap fill. So this is another example of price acting as a support and resistance level. All right, so market sentiments. This refers to the overall attitude or feeling of investors and traders towards the financial market. So now this is important because this lets you, let's say you're in a play that gapped up due to earnings, but the overall market is in a downtrend, right? It's going to be tough for that trend to continue in that uptrend direction. If investors are trading out of fear state, meaning they are selling off, it's likely that price will chop around until enough buyers step in to keep it going up, or it could just sell off like the rest of the market and fill the gap that was created. So I recommend finding plays that go with the flow of the market, not against it. So if the market is selling off, meaning going down, then I want to look for the high probability gap play to the downside. If the market was going up, then I would look for a high probability setup to where the gap, the price gapped up. So go with the flow, not against it. So not saying that a gap up situation can't play into your favor, because I have an example of that coming up soon. I just prefer the low hanging fruit. So I want to go with whatever the overall trend of the market is. That's the way I want to go. What do I mean? Let me show you. So here we have X. So white line was a previous level of resistance. We have a gap created here due to earnings, which you'll see in this image here. And the white line is the level of resistance before. So we was in a clear uptrend, price began to pull back, retracing, and then it gapped up due to earnings. Now, when this price gapped up, the overall market was selling off. So we were in a downtrend. All right. So once price got back above and broke this previous level of resistance that you see here to the left, once price got back above that, that is a strong indication that we may keep pushing up because we finally broke this level that price touched 3 times over here. So, but the market is selling off. So if you look at it on the 30-minute, yeah, it shot up, but all it did was chop around. It didn't really make any movement, nothing significant. Then the next day opened, sentiments of the market was still to the downside. It came down to this previous level of support, bounced off of it, then it chopped around again. Next day, well, after hours, you can see it came back to that same support level, then it bounced off of it. Next day, it gapped up due to unemployment numbers, right? So it pushed it up, but the sentiments of the market was still to the downside. So it chopped around, came back to this level of support again, doing after hours, and then pushed back up. Sentiments on this day, market was still to the downside. So this is clear relative strength. What does that mean? Relative strength is when a stock is outperforming what the market is doing. So if the market is going in a downtrend, but you have something holding strong to the upside, then that should be a signal to you that this may not want to come down. This may continue in its uptrend. So keep that in mind when you see the stock, the market dying, and then you see a ticker that's holding strong above and not falling off like the market is. So what we have here, we have T. Oh, this is a good one. So this is T on the 30 and then the day chart. We have a gap here that was created by earnings, fib levels, gap here, fib levels. So we attach our fibs to get the 50% and the 61.8 of the fib levels. And then we watch price. Now, again, market was in a clear downtrend. Oh, let me show you this. The white lines above are previous levels of resistance. So price got to the first level of our level of resistance. It pulled back and it just played around. The market is selling off, but buyers is trying to hold AT&T up here. All they did was chop around. Next day, AT&T shot up. Market is still in the downtrend, but buyers shot it up. We got to the higher previous level of resistance, but it pulled back, went back up, came down. It got to the bottom of the resistance level. It pushed off of it. Next day, you push down. So clearly it's selling off with the market. The market is still in the downtrend. It broke below the top of this gap. Now we're inside this gap. We pulled back, almost touched the top of the gap, almost touched the resistance level, but it didn't. And it pulled down, closed the day. Now, this is why I say you got to take profits. I say take it at the 50%. Price didn't make it to the 50%, but this is an example of why you should take some type of profits once price gets into the gap. Next day, price gapped up, unemployment numbers, right? So it created this gap, which is represented by the bold purple box here, right? So price gapped up. It went to our previous level of resistance once, pulled back. At the end of the day, it went back to the previous level of resistance and pulled back. Next day, opened up, same thing. Went to the previous level of resistance and rejected it. Now, had you not looked to the left and found this previous level of resistance, you wouldn't have known this was here. This is why you have to look to the left and see what price did previously. Market was selling off, and sellers started selling off AT&T also. Price got to the 50% level of my fib, and then it retraced. It went to go get gas. Next day, market opens. Market is still in a downtrend. So price got to the top of this gap, which is now the resistance, and pulls back. Breaks through my fib levels. We retraced, got some gas, went back to the top of the gap, rejected the resistance levels, came back down, went to the 50% level, went back up, top of the gap, went to go get some gas, rejected, came down. Next day, same thing, market sentiments to the downside, AT&T begins to sell off. So now we filled this gap once we broke this solid purple line, or the bold purple line. We broke through that. Now we came back down to our original fit that was based on this gap. And what did price do? It went to that 50%, and now it's holding on there, right? So what happens when the market opens the next day? We don't know. It might retrace. It might go ahead and just keep on filling. I don't know, but we'll play what we see. But this is how market sentiments can affect a gap up play when the whole market is going down. That first example, that held strong, but this one right here, it tried to hold strong. Buyers tried to hold it up, but eventually it got sold off just like the market. All right, so same day gap fills. These are gaps which are created during after hours of the market and are filled when the next market session takes place. Now, we touched about this in the first video, but I want to go a little bit deeper. So let's put together what we discussed so far in this session. We talked about market sentiments, looking to the left, and previous levels of support and resistance. Right? So we want to find things that's going to add to our technical analysis biases to add confluence to set up for a high probability setup. Right? So here we have snap on the 30, snap on the day. Previous gap, gap was created due to earnings, White line is a previous level of resistance. This red line is a double layer for me. So this line when price got here, this would be a new month high, and it was a previous level of support. So this is a strong level. So as you can see, price opened up. It tried to get to the top of the white resistance level. It didn't quite reach it, but it pulled all the way up, and then it started selling off. Market sentiments was to the downside. So we have market sentiment to the downside. Check. It broke through a level, but it started pulling back below that level. Check. This was the previous level of support. Check. This was a previous, this made a new monthly high and it got back below it. Check. This is all things adding to the confluence for us to take this play. And this is a high probability setup to the downside, right? Price rejected it, broke through the gap, filled that whole gap. It was the same day gap fill. It filled that whole gap. So that was 5 things that was in our favor to take this play. The more confluence you have, the more conviction you should to execute on that play. Right? So that was Snap. Now here we have Microsoft. Now Microsoft, we had a gap from previously. That was earlier in the year. That's what you have here. This large purple box here was a gap created during earnings. And then this small box that you see right here on the 15-minute, you see it is smaller on the day chart. That's what this is right here. Now we look to the left. Now, as you can see, price went to the bottom of this previous gap and it rejected off of it. And I wish I had pre-market on here because it did the same thing pre-market. It went to the gap and rejected it. This is why you look to the left and see what the alpha hours is telling you. See what the higher time frames are telling you. So once we saw that, this level acted as a level of resistance. The market sentiment was to the downside. So price began to pull back. It got in this gap, and then it went to our resistance line, and it touched it 3 times. As you can see here, 3 candles in a row, and it pulled back. So it's telling you that it doesn't want to go any higher. At least not right now. It doesn't want to go any higher. Next candle opens up even lower, below the resistance level. So it came down, did some retracement, went back to that resistance level, rejected it again, went back to that resistance level, rejected it 2 more times. So that was a good, 7 times it rejected that level. So that's clearly a strong level. Next day, market opened. Market sentiment is still to the downside. That same level that it didn't want any smoke with yesterday, it don't want smoke with today. Started pulling back. Broke through this support level, it broke through. Pulled down, almost filled the whole gap, but it didn't. It had to retrace and go get some fuel. It almost touched our resistance level, but it rejected and it pulled back down. Now we finally filled the gap here once price broke through here. And then it pulled all the way down. Now, next day, gapped up. Why did it gap up? Unemployment numbers. Is that direct news from Microsoft? No. But it causes it to gap up. But these sellers that were here are more than likely still here. So price gapped up, it continued up. And where did it run into? A previous level of resistance. We wouldn't have found this had we not looked to the left to find it. And price sold off from there on. And it went down and it filled this gap. Filled that whole gap. Right, so that's putting together everything we talked about today. We look to the left. What's the market sentiment? How can we look and build on our technical analysis biases for us to trust this play to the upside or downside, whichever way price is telling us to lean, right? Not emotional biases, not thinking, not feeling. No, we're looking at what price is telling us and we're going to trust it and execute. All right, so where can you find these gap plays? So I use barcharts.com and thinkorswim. So I'm going to show you how to do it on both platforms. So let's go to thinkorswim first. All right, so as you can see here, you're going to go into Market Watch. Going to click that. This should already be preloaded. If it's not, I'll include the code for the scanner for you to upload on thinkorswim below. But if you go to your G section, you should have a gap down and a gap up. So if I see market sentiment is to the upside, I'm going to pull up my gap up list. And once that populates, whenever it populates, there we go. All right, so then I'm going to look for any familiar tickers that we have on the list. And I'm going to look at the setup and see if price gapped up to a previous level of support or resistance. How large is the gap? Who is in control? You know, build my biases to trust that play. Now, let's say the market sentiment is to the downside, and I'm going to look for my gap down list, and I'm going to do the same thing. All right, so that's how you do it on thinkorswim. Now, on barcharts.com, let's see if I can find it. Here we go. All right, so there's two ways to do it on barchart.com. You're going to go under stocks, and the way I prefer doing it is you're going to go to before and after markets. You see here, right? You're going to click on pre-market trading. So when you click on that, you're going to scroll down just a little bit, and you're going to look for pre-market gap up and pre-market gaps down. So this is your up section and your down section. Now here is going to give you the tickers that have the largest percentage in their gaps based off the price they are currently. So this is your gap ups and then your gap down. Now another way you can do it, which is going to populate a longer list, you're going to go under performance leaders here. You see here, performance leaders. Then you're going to click on gap up and gap down. And this is going to give you a list of all the tickers that have gapped up. And then it's going to give you a list of all the tickers that gap down. All right. You can filter out which ones you want to look for and all that greatness, but I prefer to do it the other way because it's giving me the top ones with the largest gaps. All right, so that's how you find your gap plays. Hopefully that helped you guys there. All right, so like I always say, none of that stuff even matters if your mindset is not on point. It doesn't matter what I just tried to teach you. It doesn't matter if your mindset is not on point. Like I always say, trading is 90% your mind, 10% technical analysis. So you definitely become one of those lucky ones who can get by without building discipline in their mindset up to be successful, but you're only setting yourself up for short-term success. We're here for the long term, not the short term. So we have to be disciplined. We have to have the mindset to be okay with what the market does. So when trading, you want to be okay with the things that you can control, which is everything in your trading plan, your entries, your targets, your exits, your stop losses, and just looking for those high probability setups and executing. But you also have to be okay with accepting things that are out of your control. And that'll be news, earnings reports, getting upgraded or downgraded. These are things that are out of your control. And I'm sure we all been in place where price is going in our favor, we're making profit, and then all of a sudden news drop or somebody has a talk and price goes completely against your contract. You have to be okay and accept that that can happen. You have to be okay with that. Mindset is so key when trading. All right, so some quick tips before we get out of here is looking to the left. So don't try to skip to the end of the story without looking to the left and seeing the story that price is telling you. Price is telling you where we might be going. So you want to see what price did before. Technical analysis biases. So you want to make sure your biases is aligned with price. And your technical analysis is not based on what you think. Emotional biases will not get you anywhere in this market. Like I said, the market doesn't care about what you feel nor what you think. It don't even care that you make money or lose money. It doesn't care about any of that. But you want to use your technical analysis to create those biases to execute those high probability setups. And then you want to treat these gaps as support and resistance levels. So the top and bottoms of these gaps, they act as support and resistance levels. Market sentiments. What is the overall trend of the market? You want to find the plays that go with the flow in the market, or you can find plays like the example I showed you on X earlier, where it had relative strength. But like I told you, for me, I want to go with the flow of the market. So if the market is going down, Mo's going to find a gap down. If the market is going up, I'm going to go find a play that gapped up. Then you want to make sure you have a full plan in place before taking any play. I don't care if you're playing gaps or not. You should always have a full plan in place. So what is your entry? What is your targets? Your exit? Your stop losses if you use them. We are looking for high probability setup plays. That's all we can do. So you want to make sure you have that full plan in place. And last but never least is that mindset is everything. Accept what you can't control and accept what you can control. And you will be the trader that you want to be. If you get into a play and it doesn't go your way, just shake it off, exit the play, exit the trade, and just shake it off and move to the next one. There's no trader out here that can say that they've never taken a red trade. And if they do, they've only taken one trade in their life and it's green. Everybody takes red trades. We do red trades, but no red days. So shake it off, move to the next play and look for the next higher probability setup. Don't overthink it. Oh, thank you. You guys are much too kind. So I hope this video provided some more useful information on gaps and what you should actually be looking for. Stay tuned for part 2 of this series where I will break down entries and exits. And like I always say, it's either going to work or it's going to work. That's the only option. If you have any questions, feel free to drop it in the comment section below, or you can just DM me. I truly want us to all win, and we will if we just keep going and never stopping. So you put in the work, you get a good output. Till next time, thanks for breaking bread with me and stay blessed.